Hey guys, welcome back. StockBroc. Let's dive in. We're going to be doing Dutch Bros earnings today, kind of break down some opportunities, financials, trajectory for the company, strategy, all that. Let's dive right in. Revenue was up 28% year over year to $415 million. Net income jumped 73% year over year to $38.4 million. So that's pretty big for net income. Earnings per share was a beat of 44%, 26 cents compared to 18 cents. System-wide same-shop sales grew 6.1%, and all company-operated same-shop sales grew to 7.8% year over year. And adjusted EBITDA up 36.6% year over year to $89 million. So for the financials, looks pretty good. Market share, shop count reached 1,043 locations, up 14% year over year. That's a good number as well. Continuing to grow and posting good earnings, with 31 shops opening, new shops open in Q2. Aggressive expansion. Dutch Bros plans at least 160 locations, new locations in 2025. Long-term target is 7,000 shops nationwide, and they're at 1,000. Wow, that's pretty big. Their loyalty programs, over 71% of transactions are made through Dutch Rewards, so that seems to be a strong growth driver for this business. So that's good as well, especially competing with companies like Starbucks and Dunkin' Donuts and all the other small coffee shops. That's great growth right there. So their strategy for expansion is investments in new real estate and optimized site selections are boosting productivity of new shops. Corporate-owned shop growth preferred for consistency and expanded to the 19th state this quarter, Indiana. So they're slowly making a footprint in quite a few states, almost 30% or more? Maybe closer to 40% of the United States already, or 2 out of 5. Oh my gosh, yeah, close to 40%. Opportunities. Rapidly capturing the cold beverage and drive-thru market, appealing to all the younger consumers and overlooked regions like Oregon. That's one of their biggest states they operate in. Some companies in the Northwest. Not too much in California, but that's another opportunity as well. Persistent same shop sales growth, say that 5 times, fueled chiefly by higher transaction counts rather than price hikes. So they're just getting more transactions going through their locations, and then ongoing digital initiatives, menu innovation, and expansion of food programs. So I think that makes them a differentiator between someone like Starbucks, because they're really trying to push their food offerings, and it doesn't really look like Starbucks is doing that. All right, so let's talk about some of the challenges and the risk. High stock valuation, super high, 172.5 times PE, much loftier than competitors like Starbucks, which is valued pretty fairly at the moment. Cost pressures, labor and commodity inputs, especially coffee, could squeeze margins with those tariffs, so that's super risky as well. Execution risk, reliance on maintaining high growth and strong shop performance. So following at earnings like this could be very hard. With industry precedent of other brands plateauing after rapid expansion. So especially when you're in a high growth company like this and you start to plateau, that's when investors get a little spooked, and that's when the stock could be really volatile. I'm not saying this is not a great opportunity over the long term, especially if you believe in this company, but just a risk to always have on the table. And when you're investing, there's always going to be some sort of risk involved and priced in. And some sort of news could come out tomorrow, bring the stock down 10%. Anything can happen. And then also market volatility. Stock remains very volatile. High beta stock, 2.64. Basically, a high beta stock means it's more volatile. It's going to do a lot more roller coaster moves. If it's a low beta stock, considerably under like 1, that's considered a low beta stock and more slow grower, quality company, I guess you would call it. with potential for sudden pullbacks if new shops underperform. So with a lot of quick growing companies, you have to maintain those numbers, and it's quite a hard task to do. So like Nvidia has some very high growth rates, but once those start to plateau, you can see the stock go down quite a bit. So basically, there was a soundbite from the CEO, Christine Broen. Our business continues to fire on all cylinders, guided by a focused strategy, strong execution, and our amazing people. Yeah, I mean, those are just words. You just want to see numbers at the end of the day, being a stock market investor. And once you see those new stores open, get those numbers, that's all we care about. But that was a cool little quote that I pulled from the earnings call. But yeah, summary for this video: Dutch Bros basically crushed Q2 earnings, revenue up 28% year over year, net income up 73%, and EPS beating forecasts. They are gaining quiet market share with over 1,000 shops now open, on track to double by decade's end. So by 2030, there's deaths are projected at around 2,000. But that's just all words. We want to see the numbers. Massive growth potential via drive-through and tech-fueled loyalty. The risk here: high valuation, cost pressures, tariffs, and the challenge of keeping growth at this pace. This is a breakdown of Dutch Bros. Thanks for watching. StockBroc. Comment, like, peace.